Hello, my name's Warren Burkholtz. I'm a loan officer in Marietta. This is a presentation on the effect of the increasing interest rates on foreclosure rates. Should buyers be waiting? Should sellers wait? And is there a potential pending crash coming? Rather than using a crystal ball, we think looking at the history of rates is a smarter move. So using the 10-year bond and a 75-year history to monitor where 30-year rates are going. In the past, we've shown how the 10-year bond can have an adder, like icing on a cake, to reflect a precise calculation of what the rate would be for a 30-year bond for any kind of buyer, borrower, or loan program. We know that this icing is going to range between 1.5% to 3.5% depending on those programs or the risk factors involved. And we also know that during the 75-year history, using a common metric of the year 2000 US dollar, that housing values actually increased steadily, even though interest rates were increasing at the same time 10 or 15-fold. So as rates went up 10 or 15-fold, we saw housing values hardly impacted. In fact, they went up steadily 4-fold. Yet in 2007 and 8, we had a housing crisis that occurred, even as interest rates were dropping precipitously during that period for a quarter of a century prior. We had a housing crisis. So is that going to happen again? What are the factors involved there? Now keep in mind on this 10-year bond rate that we have to add the adder, the interest rate adder, based on the risk factors involved, and that adder can be between 1.5% and 3.5%. So should you be waiting to buy a house or should you be waiting to sell your house looking at interest rates? The best tool is the CNBC 10-year bond chart, which you can get online, and it's updated frequently, minute to minute practically. And this is what it looked like on January 22nd, 2019. Going back over the history as far back as the 1970s, you can see that there were spikes that were occurring then, and that actually those spikes now are quite common. They're occurring quite frequently, and obviously if you're going to be buying a house, you want to lock your loan rate at the valleys and not the peaks in that case. We're going to delve into what happened in 2016 when I claim there's a kind of a point of inflection and we're seeing a tremendous change in the direction of rates, and we can expect the future to look more like the distant past in the 50s and 60s and 70s. So to address whether or not this is a good time to buy or should you be waiting, let's look at what happened at this point of inflection. Rates had increased dramatically, almost 2% over this period on average. Let's look at the affordability factor in the meantime, and let's see if it makes sense to act now or to wait. Also, let's take a look at exactly what happened in 2007 and 8 in this next slide. So with the 2007-8 crash, we're relying on the University of California, Riverside for their data on what happened. And we're superimposing over that graphic more information from the University of California showing the foreclosure rates that were occurring month to month at the same time. Today, off to the far right hand side of this graph, after we've already reached this point of inflection where rates are increasing and they've gone on for a couple years now, we're now seeing foreclosure rates even at lower levels. We're seeing them at the lowest levels in the history of foreclosure rates in the Inland Empire, and even the serious delinquency rates are also as low as they've been in history. In fact, delinquency rates have dropped from 1.5 to 1.3% year to year, 2017 to 18, and in the middle of these increased interest rates, and foreclosure rates have held steady at 0.3%. So what is the effect of rising interest rates on the price of homes and affordability? This graph shows that even though housing prices have declined, loan amounts have declined at a 3% rate, about what we had in the fourth quarter of 2018, that as the blue bar graph shows, the cost of the housing still went up because of interest rates. So the drop of 3% in the valuation of the homes did not offset the increase in interest rates that we were seeing during that time frame. In fact, we would need to have seen a 6% decline in housing prices just to keep even par to make up for the increase in interest rate that we had during that time frame. So first-time home buyers, keep in mind that our distant past is going to be more like our future than the recent past. If you're a seller, keep in mind that rates are going to be improving, or increasing rather, on average. Hopefully we won't see the spikes that we had recently. If there are, we'll take advantage of those. If you're a first-time home buyer, realize that valuations of homes are going to trend upwards, so take advantage of any dips that might be occurring short term because of changes in inventory or the holidays or whatever. Bottom line, don't wait, act now, buy your house, refinance your house, lock that loan before rates increase. Real estate professionals, if you're interested in this topic, reach out to me and join a mastermind group dealing with Inland Empire opportunities and the effects of rates and values. Thank you.